Morning. Thank you for joining us for today's coffee talk. My name is Sean O'Brien, president of Quick Rate, and as always, am pleased to be joined by Steve Huntington. Steve, you want to go ahead and introduce yourself?
Yeah, thanks again, everybody, for spending your late Friday morning with us here. My name is Steve Huntington. I'm the Director of Analytics here at QuickRate, and spent my entire career working with community financial institutions of all varying sizes across the country, and spent more than half of that career here working with Sean at Quick Analytics.
Thank you, Steve. And as Steve said, thank all of you for joining us today. It, we appreciate you taking time out, as he said, to join us for these coffee talks. We certainly don't overlook how valuable your time is, and so we certainly appreciate you making time for us to talk about CECL. Just a reminder, you will receive a copy of the slides today and a link to the recording. Certainly throughout the presentation, you can use the Q&A box or the chat feature. We'll monitor those for questions, and we'll take those at an appropriate break or certainly at the end of the discussion today. Again, our goal with these coffee talks was to try to continue to just share what we're hearing, things that we're working on, just as a way for you to ask any questions that you might have. I think while that's our intent, I think what we've seen is you all are managing your process very well. And so I think it's again, a continued congratulations to all of you in managing the reserve process. We'll still be here, doing coffee talks, but I feel like, each month, the questions get a little bit more specific because just the general everyday managing of our reserve process, all of you are doing extremely well. So thank you all very much for working with us and certainly for being here today. As always, we start the coffee talks with just a couple of questions. I think there's 3 polling questions today, so certainly appreciate any participation that you can offer. So let me go ahead and start those. First one's really just around credit quality. I think most of us feel pretty good about where we are, but how would you describe your current credit quality environment? So we'll see how that rings true or not true. Okay, give this just another 10 or 15 seconds. Go ahead and end it and share it. 52% of you see it improving, 20% deteriorating, and 27% uncertain. Thank you for responding. Let me go to question 2. Just around the loan portfolio, if you do have any concerns, which loan portfolio subset gives you that most concern? Unsecured credit card, all unsecured loans and lines, student loans, new and used vehicle loans, 1 to 4 family mortgages and junior liens, all of the real estate loans, multifamily and C&I. So a lot of choices. Okay. All right. This is great. I'll end this one and share the results. And again, these results we will include in the email to you. That'll likely go out Monday afternoon or Tuesday morning with, again, a link to the slides or a link to the recording and a copy of the slides. So it looks like all other unsecured loans and lines is the most new and used vehicle loans, unsecured credit card, and then those really are the top 3. So again, thank you for participating. And then our final question is just around stress testing. Not sure how many of you are doing it, but in the past year, if you've used a stress test, what was it? Portfolio level, loan level, both, or neither? Okay, thank you all again. We share the results. So 37% of you did not do anything. 27 did both, 24 at portfolio level and 12% at the loan level. So again, thank you all very much for responding to those polling questions. And we will get going with the coffee talk. So as we do every time, we just want to kind of always make you aware of just enhancements we've done that we're considering. The big reminder is always that these are all optional. We never want to do anything that changes the way the tool works, but I think through suggestions from credit unions like yourself, we try to find ways, or if there's things that we think can improve or provide more context, we want to do that. If there's ways that we can, feel like we can improve the tool, we're certainly going to investigate those. So, Steve, anything you want to add here?
I'll mention a couple things real quickly. I think on our last coffee talk a couple months ago, we showed everyone how the newer scenario management and organization tool works that we rolled out in the first half of this year. Hopefully, most of you are enjoying the better organization of that part of your experience with your scenarios. We are still working on a couple different projects for the second half of this year. One of them being additional peer loss analysis and flexibility, meaning I know it's a big part of looking at CECL, looking at your reserve historically, comparing it to your peers' experience. It's a challenging thing to do with your peer groups, particularly when we're looking at credit quality data that's been relatively clean for an extended period of time. So when you're looking at, for example, median loss rates at the segment level for particular segments of the portfolio, it's hard to see long-term trends in peer data when just looking at median or even average values, because so many individual institutions within the peer group will have zero losses on any particular category of the portfolio. So when you aggregate it all up, you end up with a lot of zeros and not a lot of really good, helpful trends that give you directional analysis as to whether things are getting relatively better or relatively worse for a segment in your market. And so we're working to kind of improve the options that we give you there, including allowing you to choose a higher percentile, for example, choosing 75th or 90th percentile loss rates for a particular segment going all the way back to the last credit cycle. So it allows you to just kind of look on the margins of your peer group to see if there are cracks in the armor within the peer group, within your market for a particular loan type or segment. Where are those, even if most of your peers are not experiencing them, right? So it's just different ways to visualize that, which I think will really help you guys dig into where you're concerned, where the risk may be moving forward, even if it's not in the middle of the peer group, so to speak. And finally, we're continuing to make progress on offering you I'll call it a more streamlined alternative or a more streamlined version of the unfunded commitment calculation. That is as you know, this whole entire reserve analysis has been a process for our industry, from our accountants to our regulators and to all of our users at our credit unions. And as the regulators, as the NCUA told us, and as we've seen, the first round of exams were very much there was an expectation that credit unions would make a good faith effort at converting their reserve to a proper, accurate CECL based or ACL based calculation, and then that they would, start increasing or sharpening the point, so to speak, on exactly what their longer term expectations are for data and modeling and reserve calculations in the second round of the exams, as people have had some time to sit with it and figure out the best way to tackle it. And we've been, kept our nose to the grindstone and our ear to the ground to try to sniff out what changing expectations the NCUA and what changing expectations your auditors have as they evolve for CECL, what things we might need to present more data in order to keep them off your back, so to speak, and keep them happy. What areas where we may be doing too much and they're getting caught in the weeds and it's becoming a pain point, and we can simplify things and make it more streamlined. And so we sort of identified unfunded commitments as an area where the math was not, there's not a whole lot of math, but it is not necessarily particularly intuitive math. And so we wanted to come up with an even more streamlined alternative that that'll hopefully get you through that process if questions come up about the unfunded commitments in your exams. We don't want to put too much focus on it because it is a small part of the overall credit picture and reserve picture from a percentage standpoint. But anything that's causing you agita with in your exams, we want to get rid of that friction. And so it'll, just like everything else, if you like the way you're doing it right now, if your examiner and auditors are happy with the way you're doing your unfunded commitments, you don't need to change anything. This will just be another alternative where you can say, you know what, they're confused about this. There's another alternative. We're going to take that approach. It's even simpler. So you'll have that option later on this year.
Thank you, Stephen. Again, just a reminder, these are all optional. So just an FYI. So today we thought we'd just talk a little bit more about, how things have changed or not changed in terms of industry credit. Steve has put together some research that he's done. So I'm going to let him take it from here.
Yeah, it's funny because CECL, the idea behind CECL is that we're supposed to be taking a longer term approach to reserve, right? We're supposed to be looking at the entire economic cycle. We're supposed to be making estimates of losses over the remaining lives of the assets and not thinking in 1 year chunks and whatnot. But since CECL became a law, it was only a couple years ago that we've been looking at very kind of zooming into short periods of time because we've been comparing life before and life after and what trends we're seeing right now in our CECL universe. So we thought it would make sense to really kind of zoom out and try to cut through all the fluff and see, has any of this made a hill of beans a difference? How do we look different than we did the day before implementation, the day before COVID, the day before after the last credit cycle ended? So let's go through a couple slides here, and we're just going to kind of take a walk through this. So the first thing we would do is pull up just a long-term, hey, here's the last decade, right? The last from 2015 through the end of 2024, just annual values for reserves to loans. Now, not a whole lot can be gleaned from this because, again, we're just looking at annual chunks here. And so it's, as I call it, chunky data. But just on the surface, all the way back to 2015, median reserves to loans for credit unions, 66 basis points. Now we see a little bit of a bump up in 2020. We'll talk about why that might have happened from 64 to 68 basis points. Well, that was when COVID hit, right? Whether we actually did or did not see increased losses as a result of COVID, there was certainly perceived additional risk, and that related or resulted in an increase in reserves. Then when that risk didn't turn into additional losses for most of us, that reserve came down and then kind of bottomed out in 2022. And then we have a jump in 2023. How much of that due to the implementation of CECL and day one adjustments, and how much of that due to some deteriorating credit quality? Maybe we'll flesh out as we go today. But that's kind of the macro long term. Let's head to the next slide here. Here is where we start doing it a little bit more deeper. So let's look at quarterly data, and let's go from, let's say, the end of 2018. So we get to see COVID hit, and we get to see the implementation of CECL, and we compare before and after. So starting at the end of 2018, reserves were about 65 basis points. They had been slowly coming down over the last half decade before that, right? From 2013 through 2018, they had been trickling down because, credit quality had been getting better. We got, the further away we got from the last credit cycle, right? Everyone's memories started forgetting, and our examiners started to kind of normalizing their forward-looking expectations of losses as we got further away from the Great Recession. And they came down to 64 basis points by the beginning of COVID. Then you'll notice just in the first and second quarter of 2020, we see a little bump from 64 to 68 basis points. That was a result pretty much specifically just because of the perceived risk of COVID. And then when that perceived risk, as we said, didn't pan out from a loss perspective, they came down significantly further, back down below the 64, 65, all the way down to 50 basis point median. And then pretty much on day one, right, that first from 12/31/22 to 3/31/23, we went from 50 to 62 basis points in a day on our reserves. And that was the result of a change in methodology and approach to reserve accounting. Now, from then on, from that first quarter of 2023 on, we have seen a consistent marginal increase in reserves from about 63, 64 basis points up to where we are now at about 76 basis points. I expect if you are above or below this curve, you might still have experienced a similar pattern directionally, right, over the last few years here. And as we'll see in a minute, that's been the result of deteriorating asset quality. So let's go to the next slide. So after we look at our reserves, let's think about delinquent loans. So I did not smooth this out. I probably should have smoothed it out to make it more clear, but there is always a bit of a seasonality aspect to delinquent loans. As you can see here, there's about a spike every 4 quarters, which happens to be at the end of each year. So you get some kitchen sink kind of stuff going on, and delinquent loans always bump up at the end of a year and then come down in the first quarter of each successive year. But if you ignore those spikes and smooth it out a little bit, what you'll see is we did not have any increase in the credit union industry in delinquent loans as a result of COVID, because of governmental intervention, the way that we were accounting for those types of loans. The industry didn't see, and this is total loans, not one particular segment. And these are median values for NCUA peer group 5, which is which is everyone between 100 and 500 million in assets. So pretty much kind of the meat of your typical credit union size. And came down and bottomed out in 2022. And then we started seeing an increase in delinquencies right around the time of the change, or just before, a couple quarters before we switched to the CECL methodology. And that increase has continued. Again, if you smooth that trend out, we are at about double the median delinquencies right now as we were in mid 2022, when everyone was kind of getting ready to implement CECL. But if you look at the beginning and end of this, I didn't pick these dates for this reason, but we were at what, 62 basis points in 2018 and 64 basis points right now. So if we head to the next.
Yeah, no, as I say, a question came in. Can we attribute the jumps to the holiday season and maybe tax returns for the dive the next quarter?
All those things certainly play a role in it. Depending upon the loan type, obviously a consumer type loan is gonna behave very differently from a seasonality standpoint versus a commercial type loan. But yes, all those things play a role. So what I did then is sort of take those reserve levels, right? Reserves as a percentage of loans, and then the delinquencies as a percentage of loans. Since they have the same denominator, we can kind of get rid of the common and then just take reserves and look at them as a percentage of delinquent loans. So this is a measure of coverage or reserve coverage, right? And so as we expected during the late during 2019 and 2020, what we saw was reserves didn't change. Reserves. Actually, scroll up 2 slides. One more. We see reserves staying pretty much flat. Sorry, down 1. Reserves staying pretty much flat, 65, 64 for what, 2019, 2020. Head down. Next slide. Whereas our delinquent loans were decreasing significantly. So obviously what you end up with is, in the next slide, a significantly increasing reserve coverage, right? From just over 100% reserves to total delinquent loans to over 2 times the reserve compared to delinquent loans. And then what we saw was, remember, before we even implemented CECL, we started seeing an uptick in delinquent loans, and we started kind of moderating our reserves. So we ended up having a significant decrease in our reserve coverage. Then we get the one-time jump in the first quarter of 2023 as a result of the change in methodology, where reserves jumped significantly, so our coverage jumped, and then our coverage starts slacking down again, because since that point in time, reserves have come up some, but delinquent loans have, well, I say, whereas the reserve has come up another, from another 15 basis points, delinquent loans have gone up 25 to 30 basis points, meaning that our coverage has gone back down to about 1.2 times. So ignoring all the stuff in the middle, I wouldn't call COVID and CECL fluff, but ignoring everything in the between the beginning and the end there, 105% reserve coverage compared to total delinquencies 7 years ago, and now 119%. So it's interesting when you kind of bookend significant economic experiences with significant accounting changes and everything else in the middle, and we end up pretty close to where we were from a loss perspective, from a delinquency perspective, from a coverage perspective. As an industry, credit unions have a bit of a higher, their reserve has come up some as a result of the change in methodology and then some decrease in credit quality. But if I went back further than I did, I would find a time period in the mid-teens where reserve was right about where it's at now.
Okay, so the follow-up then is just some additional data that Steve, compiles from additional from our users. And so, Steve, you want to talk through this?
Yeah. This, in addition to all the public data from our call reports that we get each quarter, where we do a lot of this trend analysis, it's great to have as large of a user base as we do with the CECLSolver, because it allows us to look through all of those CECLSolver, to aggregate that data and present to you trends that you wouldn't be able to get anywhere else. So if you want to know, what direction your peers' WARMs are going, what direction your peers' Q factors are going at the segment level, the Q factor data at the segment level or at any level is not something that's publicly available. So you're not really going to get a good feel for that unless you have access to our system. And to just give you an idea of how large that database is, we've got over 500 unique credit unions that are using the CECLSolver tool in 47 of the 50 states. I still don't know if we've got Idaho or Alaska. Sean, we're working on it. This is the time of year I wouldn't mind making a visit up to Alaska to see if anyone's interested. Institutions from $10 million to over $9 billion. They've run at this point, I think this is not completely updated, so almost 10,000 scenarios and probably 200,000 segment level scenarios. So a very robust database where more than 10% of the credit unions in the country are using our tool, which allows us to get really good data on how their qualitative factor adjustments are changing, right? For used vehicle loans, and how their reserve levels, on the without the individually assessed loans, right? Your pooled loans, is that reserve going up or down? And are people recalculating WARMs and seeing shortening of WARMs because of higher prepayment assumptions? All that kind of data, which you can glean from using the database. So if you go to the next slide, I don't know if I did a screenshot of it. Otherwise, I'll share. Why don't I share my screen for a second so I can just show you the live version of that?
Yep.
Mm-hmm.
Okay.
All right, here we go. Oh, you know what? This might not be the right version. Hold on a second. No, it's not. All right, I need to switch gears here for 1 second. I was in the wrong development environment. All right. All right, here we go. Can you see my mouse moving around? There we go.
Yep, we're good.
So if we head over to the CECLSolver user trends, all this data has been updated with the second quarter, June 30th of 2025. And again, this is based upon the average values from, or median values from over 500 different credit unions around the country that are using the tool. So we can see what direction warms are headed. If I click on new vehicle loans, at the median level, you see warms have been decreasing. And then if I look over here, if I click on new vehicle loans and then head to the right, I can see what the median value is, and also 25th and 75th percentiles, right? So if you're calculating your own warms, or you're having us calculate them, and you're getting some questions about what assumptions or how your warms are, compared to maybe the NCUA's defaults or to your peers, you can share this data with them if that'll help kind of allay their concerns, whether it's an auditor or an examiner, and they don't really feel like digging into your loan level data to check your warms for a sanity check if they don't have to. But if you don't provide any evidence that shows that you're kind of within reason or within a range that most of your peers are in, then they might ask for additional information. The exam or the audit takes longer and everything else. So this additional data can really help streamline and that process, and just give you comfort that your warm levels are maybe headed in the same direction as your peers, or that they're within a reasonable kind of peer range. In addition to the warms, also qualitative factor adjustments. Clicking on a particular segment, you can see what the direction of Q factor adjustments are going in for your peers. You can click on, when I click on 25th, 50th, and 75th, these values update, but I can see all three of them at the same time here by just clicking on a particular segment and going. So you can see all that as well. And in addition to those things, reserve levels. Now these are the reserve levels for the pooled portfolios. It does not include the individually assessed loans. So for example, if you were comparing this, if you were saying, well, my peers are at 89 basis points in the second quarter for used vehicle loans, my peers' reserves were at 89 basis points at the 50th or median. If I head to the loan portfolio summary and I see what my reserve here is, I can see what percent that is, and I can compare my reserve percentage to my peers for these collectively assessed pools here. And yeah, I think that's all I wanted to show. This is all updated for 2Q25, as is the Excel export here. So you can export all this data for all three percentiles for all three different metrics right into Excel.
Yeah, and so again, that's just all located on the CECLSolver user trends.
Yep.
All right, let me pull up presentation again. Share here in a second. There we go. Okay. Did you want to, we'll just move to the next one then? Just
yeah, this the recent so you can head to the next slide. This is stuff that we have shared in the past. It's a good format for kind of seeing recent short-term trends in asset quality and reserves. So what I like to do is kind of segment by size, so we can see some of those trends and see whether larger or smaller or medium-sized credit unions are seeing the largest changes and absolute values in reserves over time. So here we see that the absolute smallest credit unions and the absolute biggest credit unions tend to have the largest reserves. Under $10 million in assets, 96 basis points median reserve. Over 500 million in assets, 95 basis points. But our 10 to 50, 50 to 100, and 100 to 500 are in that 70 to 75 basis point range for median reserves right now. As you can see, they have come up. If I'm looking at just the really any one of them, I looked at the 100 to 500. At the beginning of 2023, we were at 61 basis points, and it's just slowly, incrementally, consistently been bumping up to now we're at 76 basis points. And again, there has been some increase in delinquencies and losses that this is attributable to. From a regional standpoint, not a whole lot of difference. I'm working on improving the granularity of our regions so that we can maybe look at not just the entire East Coast in one swab, maybe look at the central or Northeast, Southeast, Mid-Atlantic. And so we'll have some more granularity there as we go forward to see if that makes any much of a difference, but all within 2 or 3, 4 basis points of each other. So not a whole lot geographically. Next slide. Yes, unfunded commitments. So wanted to talk about this for just a couple minutes. If you were to look on the surface and just took the median percentage of unfunded reserve for unfundeds as a percentage of total unfundeds, right? So what reserve you're putting for the unfunded commitments. If you just take a median of all the credit unions in the country, you see it stays at 0. And the reason is not because most credit unions who are calculating a reserve for their unfunded commitments are not calculating a 0. They're calculating something other than 0. However, the vast majority of credit unions around the country are still reporting 0 reserve for their unfunded commitments. What I mean by that is a couple of years ago, only 9% of credit unions were on the call reports calculating a reserve for their unfunded commitments. It wasn't even a call report line item until the beginning of 2023 with CECL. And over the last couple of years, we've seen the share or the percent of credit unions that are calculating a reserve on the unfundeds increase. So now about just under 20%, but still 80% of credit unions are still calculating 0% reserve on the unfunded commitments that they have. But if we back out all the ones that are not calculating any reserve on their unfunded commitments, we find that for those of you who are calculating a reserve, you're getting between 5, 10, 15 basis points worth, and that hasn't really changed very much over the last 3 years. So if you are calculating a reserve on your unfunded commitments as using our module or using or doing it internally, and you're putting it on your call reports, your peers are typically calculating between 5 and 15 basis points of the total unfunded balance in that reserve. So that can be a little bit hard to follow, but it's an interesting way the statistics work, where if you just looked at total median levels, you'd think that everyone's calculating 0. It's just that most people aren't calculating anything at all. Now, I'm surprised. Now, we know there's been a slow adoption of people really focusing on unfunded commitments and doing a bona fide, or even good faith effort calculation on what reserve they need for those unfunded commitments. Is just not something that you guys have had to think much about in the past. But adoption is increasing. It's still very, very below where commercial banks are. So even a small commercial bank, for example, 70% of them are calculating reserves. 75% are calculating reserves on their unfunded commitments, whereas only 20% credit unions are. So I expect that number will continue to increase, the percentage actually calculating it, and so the percentage not calculating it will decrease. But I wanted to kind of just remind everybody, just in case, where that stuff is on the call reports, because we sort of expected those numbers to be more like 50%, honestly, at this point, reporting it, but we're still only getting less than 20% of you guys as an industry putting it on the call reports. So if you head to the next slide. So that's where it goes on the call reports. For anyone who's not been doing it or hasn't been asked yet or just hasn't dealt with it, at any given point in time, expect that you may get a question about it from your examiner, your auditor, and then you're going to have to fund a separate reserve on the liability side of the balance sheet. It's not as much of a contrast there. It's just simply on the liability side. Line item 3, which is allowance for credit losses on off-balance sheet credit exposure. So if you're using our module to calculate the unfunded commitment reserve, that's where it goes on the 5300. And then finally, the last slide there, just to remind everyone, if you are just starting to record that as an allowance, obviously you're funding it through the income statement, just like everything else now. So on your credit loss expenses, which is the old loan loss provision, you've got your loan loss provision for loans and leases, that's A, and then the securities, which is negligible for most all you guys, and then off balance sheet credit exposures is D. So that's the spot where you would plug in your changes to, or your initial funding to, not initial funding, sorry, but funding to the unfunded commitment reserve goes through the income statement right there. So for anyone who hasn't had to deal with that and they've just been kind of keeping quiet and hoping nobody notices, or that their examiners are just comfortable that you have it managed through your funded loan portfolio reserve, right? There's more pressure from the accounting side to split this up as a separate entity and deal with it. And if you're going to, this is how it's done on the call reports. John?
And again, I think as Steve indicated, right, we're really, there is a pretty big contrast in the unfundeds between banks and credit unions. Again, I think we've seen on the bank side, the percentages come down dramatically over the last couple of years. Not sure if that'll happen on the credit union for the credit unions, but again, just another piece of information, we have seen a pretty significant, forced adoption, if you will, around unfunded commitments on the bank side. So it may or may not be coming to credit unions, but just an FYI, it is a notable divergence that's occurred over the last couple of years.
And I think some of the reasons that many of you might not have had any conversations about it, it's a combination of, again, first round of CECL was really good faith effort, and they're expecting more as we move forward, and it might be in your next exam, it might not. And your examiners themselves and your auditors themselves, they're learning about this. This was new to them as well. So there was probably less questions and less pressure when they had a fuzzier understanding of how it should work into your financials, or a fuzzier expectation of what level it should be at. But those are really starting to firm up now, those expectations of having it on there and around what levels they expect to see and they're seeing from your peers. So it's going to continue, I think, to kind of trickle down.
Yeah, agree. Okay, some more additional
Yeah, this is
delinquency
using
trends, Steve, that you put together.
our Excel add-in is we have a data source that allows you to connect if anyone is interested in getting this type of really detailed peer and industry data directly in an Excel environment. We have that tool as a separate option in your subscription that you can add. That I use that tool for pulling this type of data where I said, hey, pull me all the credit unions in peer group 5, right? There's about 1,100 of you, and then show me delinquencies as a percentage of total loans over the last 2.5 years. And then I throw some statistics at the bottom, and what I see is what we had talked about earlier, right? Delinquencies are on the rise, and the best way to compare them is to compare same quarter from previous year over year. So I highlighted or circled in red there, second quarter of 23, 24, and 25, and you can see 43, 57, 64. So a pretty consistent, unabated increase in median and 75th percentile and 90th percentile increases in delinquent loans across the industry. So they're continuing. Some of our commercial banks have started to see, at least in the second quarter, saw a dip in past due, like the 30 to 89 days, which is the way the commercial banks first see it on their call report, in things like mortgage loans and in some commercial loans as well. So we'll see if we see a decreasing increase or an inflection point in, but so far we haven't seen it in our credit unions yet.
Anyway, I had a comment back to the unfundeds. Wouldn't the unfunded side eventually impact the actual loan side either way?
Yeah, so it's really about front loading, right, or not front loading, because if you have a higher reserve for an unfunded commitment, once that commitment becomes a loan, right, you no longer need to fund it on the unfunded commitment side. So you've created a reserve for something that's not a loan yet, and then if it becomes a loan, you already have a reserve. Now there's the fund accounting entries of that reserve decreasing on the unfunded commitment, on the overall unfunded commitment, because let's say you funded a large one that had a reserve, so your unfunded commitment reserve is going to drop that next quarter, but your loan portfolio reserve is going to increase. So what you'd have on the income statement is provision coming off for the unfunded commitment and going on for the loan portfolio. So it ends up ignoring the entries, it ends up being a transfer of that reserve from the unfunded commitment reserve on the liability side to the contra asset account on the for net loans, pretty much on the asset side of the balance sheet. But yes, it's not, if you decide you need to fund the unfunded commitment reserve more, it's a one-time kind of, it's a consider it a one-time loss, but it's really just front loading a reserve you're going to end up with anyway, given the the funding rates that you have on those unfunded commitments. So
Okay. As you know, we've touched on this before, but we'll just briefly touch on the scenario management tool. Steve, anything you want to add here?
yeah, no, just reminding everyone, everyone's been living
Yep.
with it for a few months now, I believe. And so hopefully, well, a lot of you on the call today are some of our best users, some of our most active users who have lots and lots of scenarios. And so hopefully you're enjoying the better organization and efficiency of being able to kind of see what's been going on with the scenarios and track them over time. So that was just an administrative improvement we made there as a result of growing our user base.
Correct. The stress test, that again, we just update this quarterly. That just kind of the economic scenario indicator just gives you some
Yeah, that
information.
was a couple months ago,
Yep.
a few months ago at this point. Just reminding everyone, this is great Q factor support right here. Just showing, looking at those large macroeconomic trends and being able to go back in time quarterly for decades, and then look at baseline and severely adverse. Baseline is an actual midpoint, like median projection of a whole bunch of economists from the Fed. And you get quarterly projections over the next 3 years for these economic trends. And then the severely adverse scenario is your stress testy type scenario, right? It is not a projection. It's not a, we think this is going to happen. It's a hypothetical, how bad could it get in a worst case or close to worst case scenario type thing. So just keep in mind those two scenarios are very, very different in nature. One is real expectation. The other is just a how bad hypothetical.
Again, this kind of what we're hearing. A lot of the things are the same from the last coffee talk we had. Things that people are being asked about. Again, I think we wanted just to kind of remind you, if it isn't, particularly around Q factors, if it's not documented, oftentimes it doesn't exist. Steve touched on the unfunded commitments, but those are some of the areas where we continue to get questions from. Just a reminder, we do have information, out there on policies. It is something all of us should be doing annually. Just make sure if there's any roles and responsibilities, people who are doing things within the credit union, make sure we're documenting that in our policies. And then again, just best practices, the key inputs and assumptions, give some time or narrative to that as well. Steve, anything you want to add here before we move to the next slide?
Nope.
Okay.
Next slide.
Yeah. So again, then I think just as we continue thinking about and you think about just kind of how to communicate this or what you might be thinking about including in information to your board regulators or auditors, just some different questions or thoughts to consider.
Yeah, and one thing I do want to point out there, all the way at the bottom in red, is the peer comparison. As of now, for our credit union customers, we don't have a lot of flexibility in what peer groups you use for your CECL Q factors or for any other data that you're looking at peer data for. In Quick Analytics, it's simply the NCUA peer groups, right? And it's you can break down the NCUA's 6 peer groups by state or by region, but we're so far have been limited to their sort of the way they see and segment you guys across the board. For our commercial bank customers, we've had a lot of flexibility historically in fully customizing peer groups and having different ways of creating intelligent, thoughtful, local, well-built peer groups. And that's been a really, really popular function of our platform. And so we're working on ways to bring that element to our credit union customers moving forward. So hopefully later on this year, you guys will be able to go to the CECLSolver or go to some other tools that we'll show you about and say, hey, I want a peer group of all the credit unions between 100 and 250 million dollars in these 8 counties that surround me or in these 2 states. sort of get away from just the NCUA's strict definitions of peer groups to something more flexible, custom, and maybe appropriate for your for your local market.
Okay, then just as just in kind of a preview of some things we're working on, Steve, you want to discuss these?
Yeah, give me a minute. I've got
You want to
to
pull it up?
yeah, I got to log back in here.
Okay.
I got a lot of logins, Sean. A lot of logins.
Just a reminder, as Steve's doing that, if there's any additional questions you have that you'd like to submit for today, please go ahead and do that now, and we'll give Steve just a minute here to get logged back in.
Here we go. I'll share my screen.
Yeah,
So what
I'll
I'm about
stop.
to show you guys comes from the commercial bank side of our platform. So these are some additional tools that our commercial bank customers have access to that our credit union customers do not yet. And we're working on that. So as I go through this, be noticing things that you're really interested in, and we want to hear as much feedback as possible for, hey, you guys showed this particular page or that particular metric or visualization, and we think that one would be fantastic for for our credit union, or we already look at that kind of stuff and we can't find it anywhere. So please feel free. Trying to share. Oh, here we go. All right. So this is just Camden National Bank as a guinea pig that we use for a lot of our analyses for commercial banks. If I head over here to industry research, this is something that we're actively working on right now, turning to our credit union side of the platform as well, where you'll be able to, let's say you choose a particular segment of the portfolio and you want to look at, whether it's past due, whether or delinquent, whether it's non-accrual. Let's say I want to look at just past due loans, and I want to look at it for all the credit unions in my state, let's say. There you go. And I can compare it to my credit union here. I can go further back in time. And as you change any of these metrics, everything updates on the fly. I can refresh the chart here. So I can see here's the last 12 years. So I can add additional peer groups if I want to. I can add additional banks or credit unions. So you can compare your performance or just multiple peer groups performance, maybe at the median level, even at like the 75th or 90th percentile. And you can choose all these different metrics, and pretty much on the fly, they dynamically update the charts here. So it's just a great way to do a lot of research on industry trends. Again, this is something we're currently working on right now, adding, being able to add later this year to an offering for our credit unions. You can overlay economic trends on top of it. Like I want to see real potential GDP growth, and let's just add that, and I'll make it gray. And all the same time periods and everything else. So if you change the dates or whatnot, it's not only going to update the your institution's data and any peer groups data, but it's also going to update the economic data as well. I'm watching Greg dance here. All right, it's going a little bit slow. Now, if I head back to just the home page, this you guys already have access to. If you click on my credit union and you get a financial overview page, but it's simply this one page with some basic overview type metrics where you can change time periods, and you can change durations of the data as well. But you'll notice on the bank side, we have lots of other options. We have the ability to take a look at the balance sheet, and so see some of these balance sheet, just a full blown out balance sheet for the institution over time, and choose which metrics, which balance sheet related ones I want to compare to my peer group over time. I can choose I can custom build a peer group. So we've got balance sheet, income statement, the ability to maybe even look at your margin and do some margin composition analysis, where I can see my incomes, revenues, or expenses on my earning assets or interest-bearing liabilities compared to my balances, and see what my yields and costs are, and see how they're changing over time. So a lot of these things, we're going to be kind of picking and choosing some of these that we want to start trying to offer as an offering to our credit unions. So if this is something you'd like more detail on, which ones we're considering, or like to have your thoughts or feelings on it heard, please feel free to reach out to us and let us know what types of things you'd love to see in this type of an environment. Because yeah, that's something we're working on right now. Sean?
Agree. Yeah. So yeah, as Steve said, right, we wanted to make it most meaningful to you. We don't want to give you information that you don't want to see. But if there are areas that from the call report that we can better visualize, or you'd like to compare and contrast yourself to other credit unions, please let us know as we continue to develop this out going forward. Just a reminder, any of the past webinars you can be found in our YouTube channel. Upcoming next month, we'll be back for another coffee talk. Please register as always, as with every webinar at Quick Rate or Quick Analytics. If you register, you will receive a copy of the slides and a link to the recordings. Steve, any final thoughts or comments before we let everyone off to their day and weekend?
Nope. Just if anyone has a hookup in Alaska who's looking for some CECL support, particularly now in August, please let me know.
Very good. Thank you all again. We really appreciate your attendance today and continued support with us. We thank you as always. Let me just make sure. Yep, thank you. And if we can be of help, reach out to us. Info at Quick Rate. Reach out to David or Jason or our customer service team, and we'll quickly respond. So thanks again for your time today. Have a great weekend, and we'll see you next month.
Thanks,
See ya.
everyone.